So I want you to picture a teenager, right? They're out running sprints on this like dusty, sun-baked high school football field.
Oh, yeah, the classic Friday Night Lights image.
Exactly. They are sweating, just pushing themselves to the absolute limit, and it's all fueled by this single burning dream of landing a college scholarship, something that could completely change their family's trajectory.
Right, it's a very visceral, human kind of ambition.
It really is. But now I want you to contrast that raw human image with a humming computer server sitting in some Wall Street data center.
That is quite the pivot.
I know, right? But imagine the server is executing a multi-million-dollar reverse stock split just to keep a tiny micro-cap company from being like entirely wiped off a public stock exchange.
Wow.
Yeah. And today we are looking at how those two vastly different worlds just violently collide.
It's a pretty fascinating collision, too.
It really is. We're doing a deep dive into the 2024 SEC filings of a youth sports app called Signing Day Sports. Their ticker symbol is SGN, by the way. And we're placing that right alongside some recent trading commentary about this AI robotics fund known as $BOT.
Right, the BOT fund.
Yeah. And when you put these two together, a really stark picture of our modern economy starts to emerge. We're essentially exploring this frontier where ambitious tech, youth sports dreams, and the deeply, deeply disconnected realities of the public financial markets all just smash into each other.
A lot to untangle.
It is. Okay, let's unpack this. Because on the surface, a high school recruiting app and a multi-million-dollar AI robotics fund seem, well, entirely unrelated.
Yeah, they really do look completely unrelated, at least until you start actually reading the fine print.
Right.
Because, one is fundamentally about teenagers just trying to get noticed by college coaches, right? And the other is about retail investors scrambling to buy into, private AI assets.
Two completely different consumer bases.
Exactly.
Yeah.
But when you put the mechanics of these two operations side by side, they expose some pretty profound truths about how our digital economy actually functions today.
Like what kind of truths?
Well, specifically, they show us how narratives are packaged, how ambition gets funded, and ultimately, how hope is monetized on the open market. We are basically looking at two totally different strategies for surviving the public markets.
That is a great way to frame it. So let's start on the ground level with Signing Day Sports, or SGN.
Sounds good.
Because before we dissect all the wild financial engineering happening in their 10K report, we kind of need to understand the physical, real-world problem they are trying to solve.
Right, the actual product.
Yeah. So they launched this platform back in 2019, and currently they support football, baseball, softball, and men's and women's soccer.
Okay, so the major sports.
Exactly. Now, if you are a parent listening to this, or honestly, if you've ever just been a student athlete yourself, the traditional college recruiting system is, well, it's broken.
Oh, completely broke.
It is so heavily biased by geography, and it's incredibly restrictive if your family doesn't have a lot of money.
Yeah, the historical model of college recruiting is, it's essentially built on geographic luck and your family's discretionary income.
Which is pretty unfair when you think about it.
It is. Think about a major university's recruiting budget. Coaches simply cannot fly everywhere. They go to the major high schools in the major talent hotbeds. Texas, Florida, California.
The usual suspects.
Right. So if you are a highly talented kid in some rural town in the Midwest, and your parents cannot afford to fly you across the country to these exclusive, like, $500 a weekend showcase camps.
Which are so expensive, by the way.
Exactly. If you can't go, you are essentially invisible. You just aren't on the radar because the radar literally doesn't point at your town.
It's like trying to hire someone for a crucial high-stakes job at your company, but you establish this crazy rule where you can only interview candidates who can afford to buy a first-class ticket to fly to your office.
Right. It makes no business sense.
Sure. And their resume. It's just a piece of loose-leaf paper their parents wrote filled with these completely unverified claims like, trust me, my son runs a 4.4 40-yard dash.
Yeah, just take my word for it.
You would never run a real business that way. And that is exactly what SGN is trying to fix. They are basically positioning themselves to be like the LinkedIn for student athletes, but combined with a built-in lie detector test.
And that lie detector aspect, that's the actual product here. SGN calls them video-verified measurables.
Video verified measurables. Okay.
Right, because in the old days, a kid would just upload some flashy, heavily edited highlight reel to YouTube.
With the heavy rap music in the background, yeah.
Exactly. But a highlight reel doesn't actually tell a recruiter if the kid is really 6'2", or if he's, 5'9", wearing tall cleats and standing on his toes.
Good point.
SGN's platform demands verifiable, objective data. We're talking about exact, verified height, weight, wingspan, hand size.
Hand size is huge for quarterbacks.
Exactly. Plus official academic transcripts and video-recorded sprint times that are actually standardized.
Okay, so it levels the playing field.
It does. The platform allows a recruiter sitting in an office in, say, Ohio, to evaluate a prospect out in Oregon, frame by frame, completely sidestepping all the travel costs and the guesswork.
Which is obviously a massive win for the athletes. But, put yourself in the shoes of a major Division I football coach. Why do they care enough to actually make this an industry standard?
Well, if we connect this to the bigger picture of college athletics, you have to realize that recruiting is not just about finding talent. It is an exercise in extreme risk mitigation.
Oh, interesting. How so?
A full-ride scholarship at a major university, that is a six-figure investment. And recruiting budgets are totally finite.
Right.
So every single time a college program offers a scholarship to an athlete who doesn't pan out, maybe the reported speed was just a total fabrication, or they show up and they're academically ineligible from day one.
Which happens all the time.
It does. And that is a massive financial and competitive loss for the school. So SGN is really selling risk reduction.
Okay, that makes sense.
By providing verified data, they remove those blind spots. They establish this baseline of trust before a coach ever burns a plane ticket to visit a high school. It just makes the university's capital allocation drastically more efficient.
So the core product makes total logical sense. You are taking this incredibly inefficient, paper and handshake process, and you're digitizing and verifying it.
Yep, exactly.
But when you start reading the forward-looking statements in this SEC 10K, well, SGN does not just want to be a digital filing cabinet for high school transcripts.
No, not at all.
Their ambitions are frankly staggering. They want to be the unavoidable infrastructure of the entire sports world, and they are leaning incredibly hard into artificial intelligence to get there.
Oh yeah, the technology roadmap they lay out is super aggressive. According to the filings, they actually already deployed an AI lead scraping tech back in November of 2023.
Wait, really? Just scraping for leads?
Yeah. That algorithm scans potential leads and crafts highly personalized outreach messages to identify athletes who match their target demographics.
Wow.
But the future roadmap is where it gets really dense.
It does. They are outlining a plan for a full AI matchmaking algorithm by the third quarter of 2025.
Which is right around the corner.
Exactly. This would take a college recruiter's specific criteria, say, a Division II soccer coach is looking for a forward with a 3.5 GPA and a very specific top speed.
Right.
And the AI would automatically push matching athletes right to the top of their feed based on historical data.
It's wild.
And it gets crazier. They're even plotting to integrate AI video capturing hardware at physical fields. Cameras that can automatically recognize a player's jersey number, track them, and just build a highlight reel without a human ever touching an editing program.
That's the holy grail for sports tech right there.
I even see notes in there about AI chatbots giving these kids personalized nutrition plans.
So it's really the creation of a closed-loop digital ecosystem.
A closed loop? What do you mean by that?
They don't just want the student-athlete using the app for a few minutes. They want the student-athlete living inside the app. But, to make an ecosystem like that actually valuable, you need a critical mass of users.
You need everybody on it.
Exactly. You have to force the technology to become the industry standard. And SGN is trying to achieve that through these massive, highly strategic partnerships.
Right.
Take their deal with the U.S. Army Bowl. This is a major national all-star game and combine series for high school football players.
It's a huge event.
Huge. SGN committed $450,000 in sponsorship payments through 2026. And in return, they are the exclusive national recruiting partner, and SGN gets a $60 stipend for every single athlete that attends these national combines.
Meaning every single kid who shows up to these massive combines gets their data automatically uploaded into the SGN platform.
Yes, exactly.
They are capturing the data right at the source. But I have to stop and just push back here for a second.
Sure.
Because I am reading this SEC filing,
Hmm.
and I see all these grand, like, Silicon Valley-style plans for advanced AI, matchmaking algorithms, automated camera hardware integration, intelligent chatbots.
Ambitious stuff.
Very. But then I flip to the corporate structure page. As of April 2025, Signing Day Sports has 9 employees.
Yep, 9.
9. 6 full-time, 3 part-time. I mean, are they not biting off way more than they can chew? How does a company with the headcount of a local coffee shop build out advanced AI infrastructure when their core product, just getting kids noticed, is still fighting for market share?
That tension right there. That is the defining characteristic of this company's filing.
It has to be.
The ambition is planetary, but the operational footprint is microscopic.
Oh.
However, their strategy isn't to actually build all of this advanced tech from scratch in-house.
Oh, really?
No, their strategy is entirely about rapid user acquisition.
Yeah.
They believe if they can capture the entire market first, the tech integration will just follow, or they'll become a prime acquisition target for a bigger company.
Get the users first, figure out the tech later.
Precisely. Which brings us to their other massive partnership, which I think perfectly illustrates this growth at all costs mentality.
The EDP deal.
Yes.
Yeah.
Elite Development Program, soccer, or EDP. What's fascinating here is how this functions purely as a customer acquisition strategy, but it's just disguised as a partnership.
Let's dissect the numbers on that EDP deal because they reveal so much about the actual mechanics of building a tech platform. EDP is this youth soccer organizer with over 150,000 players in their
A
system.
massive pool of players.
And SGN obviously wants those players, so how do they get them?
Well, SGN structurally embeds themselves into the EDP organization. The agreement states that SGN will offer a discounted annual subscription to EDP players. They charge them $175 instead of their usual, $250.
Okay, pretty standard discount.
Right. But rather than just taking that $175 as revenue, SGN turns around and remits $50 back to EDP for every single subscription generated.
Wait, they just hand cash back to the league?
Yes. And further, they pay EDP a flat $75,000 every single year just to fund dedicated staff whose sole job is to promote the SGN app to the players.
You're kidding.
No. And to top it all off, they structured this tiered revenue-sharing model where EDP can take up to 15% of the gross revenue if the referrals cross the $6 million mark.
I want to make sure you, the listener, really grasps the business mechanics happening here. SGN is essentially buying a captive audience.
100%.
In the tech world, this is a textbook example of astronomically high customer acquisition costs. For a platform like this to work, a two-sided marketplace, you have the classic chicken and egg problem.
Yep, the hardest part of any marketplace.
The platform is utterly useless to a college recruiter if there are no high school players on it, and it is completely useless to a high school player if there are no recruiters looking at it. So SGN is actively choosing to bleed money to subsidize the player side of the equation.
Exactly.
They are paying youth leagues to practically force their players onto the app.
It is a deliberate loss leader strategy. From a pure business mechanics standpoint, SGN is willing to obliterate their profit margins today just to acquire a critical mass of users for tomorrow.
It's a huge gamble.
It is. They are betting that once they hit a certain threshold of players, the college programs will just have no choice but to adopt the software. The friction, however, is that this kind of strategy requires a massive war chest of capital.
Which brings us to the brutal wall of reality, because SGN is basically destroying its own stock just to fund a real physical product.
Yeah, it gets messy here.
You read the marketing narrative, right? Digitizing sports, democratizing access, integrating AI, capturing 150,000 player soccer leagues. I mean, it sounds like a billion-dollar unicorn startup.
It sounds great on a pitch deck.
But then you turn to the balance sheet section of the 10K, and the financial reality check here is like taking an ice bath.
The contrast between the pitch deck and the balance sheet is so stark. If you only look at top-line revenue growth, the company actually looks healthy. Yeah, I mean, they doubled their sales, up 100.1% year over year in 2024. They reached over 8,300 paying subscribers.
That sounds like a win.
Sure, but 100% sales growth is largely meaningless if the underlying unit economics, the actual cost to acquire and service those 8,300 users are just bleeding the company dry.
And the numbers are grim. As of December 31st, 2024, SGN reported total assets of roughly $1.1 million. But against that, their stockholders' deficit is $2.2 million.
Oh,
Yeah, the hole is twice as deep as the ladder is tall. And consequently, the company's own management and their independent auditors included a going concern warning in this SEC filing.
which is a huge deal.
I want to emphasize what that means for you listening. A going concern clause isn't just standard legal boilerplate. It is the ultimate financial red flag. It is an auditor legally stating to the public, hey, we have substantial doubt this company will even exist 12 months from now.
It's the loudest alarm bell an auditor can ring.
Exactly. So if you're a parent listening to this and you've just paid $250 so your kid can get noticed by a scout, you probably assume that money is going toward, I don't know, hiring more developers or running better marketing.
You'd think so.
But the filings tell a completely different story. Your subscription is basically subsidizing their desperate fight for public market survival. How does a company double its sales and still end up with a going concern warning?
Well, this raises an important question about the structural trap of the public markets, especially for microcap companies.
Right.
SGN went public to raise the capital needed to fund those expensive loss leader partnerships we just analyzed, right?
Right.
But being a public entity carries massive, inescapable fixed costs. We are talking about mandatory auditing fees, legal compliance, really complex SEC reporting, and specialized insurance.
Just the cost of doing business as a public company.
Exactly.
Yeah.
And for a microcap company with only 9 employees, those public compliance costs are just a crushing weight. They can easily outpace the entire revenue brought in by 8,000 app subscriptions.
Wow.
You end up running on this treadmill where you have to spend millions just to legally remain a public company.
And because they are trapped on that treadmill, just burning through cash to keep the lights on, they have to resort to some pretty extreme financial maneuvers.
Oh, yeah.
Like, the filing details a massive 1-for-48 reverse stock split that happened in November 2024.
That's a big ratio.
It is. Let's break down what that actually means conceptually. A reverse split is essentially a survival tactic to avoid being kicked off a stock exchange.
Right.
So if you own a pizza cut into 48 slices and I magically consolidate all 48 of those slices back into one giant pie, you don't have any more pizza than you did a second ago.
Nope. Same amount of calories.
Exactly. The total value hasn't changed. SGN's stock price was dropping so low, it was violating the NYSE American Exchange's minimum price rules. So they took 48 shares and consolidated them into one. The price of that single share looks 48 times higher on the ticker, which tricks the exchange's computer systems, but the actual value of the company hasn't improved a single cent.
It doesn't solve the underlying cash burn at all. It just resets the clock.
Yeah, exactly.
And alongside that reverse split, the 10K exposes their use of a committed equity financing facility.
Oh, this part is wild.
Let's explain the mechanics of this because it is basically the definition of a death spiral. In simple terms, SGN has a contractual agreement to continuously print newly created shares of their own stock and dump them into the open market just to raise the cash needed to pay their bills.
Just printing shares.
Exactly. But every single time they do that, they are diluting the ownership percentage of every existing shareholder.
It's like having a leaky bucket that you try to fix by drilling more holes.
That's a great way to put it.
They need cash, so they print new shares. Printing new shares dilutes the value, which obviously causes the stock price to fall. Because the stock price fell, the next time they need cash, they have to print even more shares to raise the exact same amount of money. It is a vicious, inescapable downward spiral. They are structurally trapped in the immensely expensive reality of trying to fund a tangible, physical world business using the unforgiving machinery of the public markets.
Which is the perfect pivot point for our next topic.
Oh, yeah.
Because SGN is bleeding out in the physical world, trying to fund an app that helps a teenager get a scholarship. So what happens when we look at a financial vehicle that operates entirely in the realm of hype and narrative?
The irony of the modern stock market is that if SGN entirely abandoned high school sports, fired everyone, and just rebranded themselves as an AI robotics holding company, Wall Street might throw hundreds of millions of dollars at them.
Sad, but probably true.
Which brings us to our second source. And here's where it gets really interesting. Let's look at the financial commentary regarding the fund known as $BOT.
The juxtaposition here is exactly why we need to analyze these two documents together. It shows us two entirely different realities coexisting on the very same public exchanges.
According to this financial commentary, the BOT fund is currently trading at 4 times its net asset value, or NAV.
4 times.
To put that in perspective, the fund holds about $146 million in actual quantifiable private assets. Yet the public market has driven the fund's market cap up to roughly $600 million.
That's incredible.
To use an analogy, it's like taking a crisp $100 bill, placing it inside a nice leather wallet, setting it on a table, and watching a crowd of public investors happily bid the price of that wallet up to $400.
Right.
Why on earth would the market pay $400 for a wallet that explicitly, mathematically, only contains $100?
From a traditional fundamental analysis standpoint, it makes zero sense. The net asset value is the literal floor. It is the math. In an efficient, rational market, a fund like this should trade at or very near its NAV.
Right, the $100.
Exactly. But BOT is an AI robotics fund, holding shares in private companies. And right now, retail investors are largely locked out of early-stage private markets. They just can't buy into these massive AI startups before they go public.
The door is closed to them.
Exactly. And because the overarching macro narrative around artificial intelligence and humanoid robotics is so deeply intoxicating right now, retail investors are willing to pay a staggering, irrational premium just to gain proximity to these private assets. They aren't buying the math anymore. They are buying the narrative.
The source text points out a hyper-specific absurdity to really highlight how broken this valuation is. The BOT fund owns a stake worth roughly $37 million in a private robotics company called Figure.
Okay.
Because the BOT fund as a whole is trading at that massive 4x premium, the market is implicitly valuing the company Figure at an astronomical $160 billion. I want you to hold that number in your head. $160 billion. Meanwhile, a leading competitor in the exact same humanoid robot space, a company called Unitree, which actually produces tangible working robots, is currently preparing for an IPO.
And what's their valuation?
Their expected valuation, just $6 billion.
That is a massive gap.
Right. You have a $160 billion implied valuation driven purely by secondary market hype, competing against a $6 billion valuation anchored in reality.
This extreme disconnect leaves the author of the commentary to ask whether this actually constitutes a predatory transfer of wealth from retail investors.
Predatory, that's a strong word.
It is. But if we look impartially at the mechanics of how the fund operates, the warning signs are glaring. The text highlights that the operators of the BOT fund have a $2 billion effective ATM offering in place.
An ATM offering.
Yeah, ATM stands for at the market. Conceptually, it is the exact same mechanism as that equity financing facility that SGN uses.
Oh, the share printing machine.
Yes. It allows the fund to continuously issue new shares to the public to raise cash. But the context here makes it entirely different.
Okay, I want to make sure I'm mapping this out correctly. So SGN uses their equity facility because they're literally out of cash and just trying to survive.
Right.
But BOT is using a $2 billion ATM facility while their stock is trading at a 400% premium to reality. So the fund operators know the underlying assets are only worth $146 million.
They absolutely know.
And they know the public is irrationally bidding the price up to $600 million. And their response is to just fire up the printers and sell $2 billion worth of newly created shares to those retail investors at that massively inflated price.
That is the core argument the source is presenting. Even if the operators of the fund initially launched with, the noble intention of democratizing access to private tech companies for the average investor,
Sure.
utilizing a massive ATM facility under these specific conditions is highly questionable. When there is a 4x disconnect between the literal net asset value and the market price, issuing new shares means the fund is directly capturing the spread of that irrational exuberance.
They're profiting off the FOMO.
Precisely. They're actively selling those $100 bills for $400 over and over again, taking advantage of the retail investor's fear of missing out.
It is absolute madness when you pull back and look at the macro picture here.
It really is.
On one side of the ledger, you have signing day sports, 9 employees fighting tooth and nail in the physical world, executing desperate reverse stock splits, bleeding cash, diluting their shareholders into oblivion just to keep an AWS server running so some high school quarterback in Ohio can get his transcript to a recruiter.
The physical reality.
Exactly. On the other side, you have the BOT fund, generating hundreds of millions, potentially billions of dollars in market valuation, almost entirely off the paper markups of private assets, capitalizing purely on speculative frenzy.
It beautifully illustrates the dichotomy of capital allocation in the modern era. The market penalizes SGN mercilessly because its costs are tangible, its growth is linear, and its friction points like physically paying EDP $50 for every user are plainly visible on the balance sheet.
You can see the struggle.
Right. Conversely, the market rewards BOT because it represents pure, unadulterated potential. It isn't weighed down by the messy friction of high school sports leagues. It is riding the frictionless wave of the AI revolution.
So as we wrap up this deep dive, let's bring it back to you, the listener. What is the practical takeaway here?
Good question.
Whether you are a parent trying to evaluate which tech platform to trust with your kid's athletic future, or you're an investor trying to navigate the absolute chaos of the stock market, the lesson is that you must ruthlessly separate the pitch from the mechanics.
Absolutely.
You have to look under the hood. A compelling narrative, whether it's the noble goal of democratizing college sports or the sci-fi promise of AI robotics, is a powerful drug.
Very powerful.
But a beautifully crafted narrative does not alter the fundamental math on a balance sheet. You have to understand the vast canyon that often exists between the ambition of a marketing campaign and the cold, unyielding reality of an SEC 10K filing.
Building on that, I think there is a deeper philosophical thread connecting these two sources that you should really mull over.
Okay, let's hear it.
Consider the concept of the commodification of hope.
The commodification of hope.
Yes. In the case of signing day sports, what are those parents and athletes actually purchasing for $250 a year? They aren't just buying server space for a video. They are buying the hope of a college scholarship.
Right, the dream.
Exactly. They are buying the dream of a transformed future. Now, apply that same exact lens to the BOT fund. What are those retail investors actually buying when they willingly pay a 400% premium over the mathematical value of an asset?
The same thing.
Yep. They are buying the hope of getting in early on the next technological revolution. They are betting the dream of generational wealth. Ultimately, this leaves us with a pretty provocative question to consider. Are today's public markets actually pricing in the fundamental value of businesses and technology? Or have they simply evolved into highly sophisticated engines designed to price in the desperation and the aspirations of the end consumer?
Wow, it really makes you look differently at that teenager sweating on the football field and that Wall Street server quietly executing trades in the dark. They seem completely unrelated, but they are both caught in the exact same machine, just playing different positions. Thanks for joining us on this deep dive.